So our special guest today, as you just saw, Apollo Lupescu. Apollo is Dr. Lupescu, actually. He has his PhD in economics and finance from the University of California, Santa Barbara. We're going to hear about that later. Apollo, I thought that was a party school up there.
More for undergraduates. Graduates are like, I don't think they let us in. They're like, no, you're too old for this. Just go somewhere else.
Anyway, Apollo has the title over at Dimensional as being the Secretary of Explaining Stuff. That's a real official title there. And
big marketing budget.
Exactly. And so, you know, what they use Apollo for is to talk to advisors, but even further to his skill, he actually speaks to end clients like we do. And he often works with advisors doing maybe a local seminar, or in this case, a webcast. And here we have the ability to share his great skills of communication with about 400 of you who are on today's webcast. So I think with that, I'm going to ask Apollo a few questions in a town hall type style, and we're going to get some of his responses, and he's going to share both probably his personal response as well as Dimensional Fund Advisors' perspective on some of these questions. So first thing, Apollo, you know, we're all afraid of this coronavirus, or maybe not all of us, but most people are. And we're also, as investors, concerned about what that does to our portfolio, and our emotions at this point in time can be quite strong and can have a negative effect on our decisions. So could you just speak a moment about the emotional impact and some of what we call the behavioral finance considerations during tumultuous times like this in markets?
Yeah, well, actually, Mark, first of all, thank you so much for having us, and thanks to everyone for attending. And it is actually a great place to start because these are very emotional times. Not only that we have this market volatility and everybody looking at what's going on in there, but on a more fundamental level, we are worried about the well-being of ourselves and our family members. And frankly, on a personal level, we have had very, very close family members who have had the COVID-19 caused by the coronavirus. You know, there is the economy around us. The restaurants are closed, and you can't even go to the beach, and everything is shut down. So there has to be a toll that's enacted upon us by everything that we see. And I think that's a really important place to start, because I won't touch on the health stuff. I won't touch on the business right now, but rather focus a bit on the market and the emotions when it comes to that. And one of the things that I found interesting is that as you look at the last 10 to 12 years in the U.S. stock market after the great financial crisis, we have had a fairly steady climb. And what's remarkable about the last 10 or 12 years is how unremarkable they've been. In other words, the market over the past 10, 12 years has been unusually quiet. And I think a lot of investors have gotten used to that idea. Well, there's not much to see here. You turn on the news and there's like the market's gone up a little bit. Every once in a while, there's a tiny pullback and then it goes back up again. So, you know, quite a lot of folks were happy with the market and where it was. And not, I wouldn't say contempt, but there are no real emotions that were involved in the market for many, many years, except maybe this idea that this is a good time to buy. Everything seems to be on track. And that was not necessarily the norm. I mean, when we study the numbers historically, I know you, Mark, are so good at this, is you see that the markets typically tend to be a lot more volatile than we've seen the last 10 or 12 years. So having gotten to this, you know, pretty quiet regime, all of a sudden, towards the beginning of this year, we've had this big dip. And the big dip, not only that it made people unhappy and a little cautious about it, but it started to trigger emotions that have not surfaced for a long time. And I think the primary emotion that I've seen investors pretty much around the country has been around fear. And it's the caution that the dangers here. So I got to be careful. And I think that, first of all, I would start by telling everybody it is absolutely fine to feel this emotion. There's nothing wrong with a human emotion. In fact, it probably saved us as a human species, because when there's somebody chasing us, well, I'm afraid I'm going to run, and fleeing saved my life. And in the context of the market, fleeing has manifested in some people thinking that selling would protect them. But it's this idea that when you look at the investor emotions, and to what you said, the behavioral aspect of investing, the cycle of emotions tend to be counterproductive relative to what investors should do. Because if you think as an investor, the fundamental premise of investing is buy low and sell high. But the cycle of emotions is almost like making people do exactly the opposite. Buy when things are high and they're looking good, and you sell at the bottom. So that's why it's really important to pay attention to the emotional side, because emotions dominate a lot of the actions that we take. And for the past few months and weeks, what I've seen is these emotions have been exacerbated and triggered not only by what's happened in the market, but the bombardment of notifications and alerts. And I don't even ask for it, but on my phone every day I get a note of how the market did. And it's basically caused people to be on this almost like I would say a roller coaster of emotions, where the cycles have shortened and they're steeper. And this is not necessarily good, because the stock market investing shouldn't be about day to day, but rather it's a longer term proposition. And I have to say that that's this actually, a roller coaster is probably a pretty adept way to looking at it. Because my daughter's 13, and last year she asked me to go with her and her girlfriends to Six Flags, and I ended up going on these roller coasters, and I knew that I was getting to the crest, that my stomach will be turning on that ride, but I also knew that I'm better off staying in my seat rather than try to jump out in the middle of it. And the only people who get hurt on a roller coaster are the boys who want to jump out in the middle of it. And I think it's kind of a little bit like that for investors. You're better off riding it, even if your stomach is turning, rather than try to get out of your seat and do something else. And that's a value that I think you also bring yourself to this process, because part of the idea here is that pay attention to your emotions, but disentangle these emotions from investment decisions. Whenever you think about what to do to my money, try to make sure that it's not because it's clouded with some emotion, whether it's fear or could be greed or whatever other emotion it is. And that's a huge role that advisors have, is coach you through these times when you feel like doing something that's not necessarily in your best interest.
Can you go back to your little diagram? Because one of the things that reminded me of is one of the things we like to do is find the roller coaster that is appropriate for different clients. So let's just assume for a moment that's a portfolio 100% equity. Overlay on that a portfolio 50-50, for example. And you can see, if you want to draw on there, maybe 50-50 is something less than that, right, on both sides. And this is one of the questions, that keep coming up. Am I in the right risk level, given my risk capacity? And when you reduce that risk, you reduce these probabilities that you're going to have your emotions sort of take over your investments and create problems for your long-term returns.
And you touched it. I mean, this is probably the biggest decision that you can make in investing. And on your website, I know you have all the risk portfolios, and why is it? Maybe I want to take a minute to really highlight why Mark just said is so crucially important. There are two very distinct ways in which you can deploy your capital as an investor. One way is you buy a stake of ownership into companies, and that's what you do in the stock market. Now, historically, over the long run, you look 20, 30, all the way to 90 years, the stock market has grown at a rate of about 9 to 10% per year. That's the historical long-term growth in the market. My dad, he is 93. He's born in 1926. If his parents had put $1 into this market and left it alone over the long run, good times, bad times, you do have the fluctuation of the roller coaster that Mark and I showed you. But the question is, what would have happened if my grandparents, his parents, had put $1 into this S&P 500, which is a representation of the U.S. market? How would that have grown? And it turns out there is a book here that Mark and I really share the love for. It's the big book of numbers, the encyclopedia of numbers. And I don't sleep with it. It's not always next to me, but I often refer to it. And it's interesting for me to see what the dollar would have grown in my dad's lifetime by the time he turned 92. He's 93 right now. But by the time he turned 92, what you see is that $1 would have grown to about $7,000. I wish my grandparents had put $100 in there, but that's the difference. The point is that this is a really nice growth over the long run. It's a really nice growth. $1 turned into $7,000 in his lifetime. But it does come with a lot of choppiness and a lot of unhappy years. So if you wanted to protect, that's what Mark is suggesting, is that probably the most effective way to do it is not to move it out of the market. And we'll come back to this, but rather focus on something that you can control. And it's the alternative to equity ownership, which is lending. You can lend your money to corporations and governments, and there's a contract in place. And the contract specifies the interest rate for a period of time. And at the end of the contract, you get your principal back. That is called a bond. And a bond is very different because you know exactly what interest rate you'll get for how long. And if this is issued by a credit-worthy issuer, like, for example, the U.S. government, which has never missed an interest payment or principal, then you kind of get a sense that they're pretty credit-worthy. I know that they'll give me what they promised. And if you do that with something that is not over 10, 20, 30 years, let's just take the shortest one you can get, is the 30-day Treasury bill issued by the U.S. government. You give them the money, 30 days later, you get the money back plus interest. Historically, over the past 92 years, there has never been a single calendar year when you would have lost money. Very little fluctuation in value relative to stocks. And in fact, when you look at it, it's not only a little fluctuation, you never lose money. There's not a year when you open your statement and you see, oops, I lost money. Right. So if somebody wants some stability and some risk management from that perspective, a good place to start, it's probably the best place to start, is look at bonds. And if you look at bonds in that respect, what they've done for these very short-term government bonds is another good thing about them. They return to investors just a little bit above inflation. Inflation historically has been about 3% on average. You got a little bit above it. So at least you beat inflation. Now, inflation is lower today, so are the interest rates. But the point is that you got your inflation. The thing that I want people to realize why this is such an important dynamic between stocks and bonds. If you had taken the exact same dollar over the same exact time frame and invested it in the safety of these treasury bills at 3-4% instead of 9-10, I would ask the people in the audience, think about what would that 7,000 turn into. So if you know that at 9-10% is 7,000, at 3-4%, what would that number be? And again, from this book, we actually got to see that the real number, the actual number for that growth, is a whopping $21. Yep. Not missing any zeros.
Right.
That's the trade-off. That's why when you look at the IFA website, what you see is their risk-based portfolios that go in these increments, because there's such a dramatic difference between the growth in stocks versus the stability of the bonds. And that's something that is so custom to you. And I know you guys have so many risk capacity surveys and you have financial plans. You look and say, what return do you need? And then try to match somebody very precisely with the right mix of stocks and bonds. But this is why it's such a crucial part of investing, and to balance these two competing objectives, stability versus growth.
Let's move on to another topic here. And I want to talk about the functioning of our markets. Mm-hmm. So we probably all seen that there's nobody on the floor of the New York Stock Exchange now. They're doing this all electronically. And in times like this, I think a lot of people think, well, maybe, the prices derived in this market aren't really a fair price. which is the conclusion of the efficient market hypothesis, and maybe that markets are not functioning properly, and therefore, I can't trust the price.
I would actually argue that right now in the market, there is perfect disagreement among investors. And why is that? Because the market basically also is a place where there are millions and millions of deals being made every day. Some people in society, whether institutions or individuals, they decide that they want to sell. And there's some others who want to buy. And if you think about it, for every seller, there has to be a buyer. For every pessimist, there has to be an optimist. And when they trade, so presumably the person selling thinks, well, the market's going to keep going down, so let me get out. The person buying thinks it's going to go up, and that's why they're buying. And that's where the disagreement comes from. When the deal happens at that instant, nobody knows who will be right, the buyer or the sellers. But the beauty of the stock market is that it's taken into account not only the pessimistic views, but also the optimistic. Yep. It's looking at saying, when you put in this hopper all these little pieces of information, you get sort of like an estimate that is not an opinion of any one person, but rather it's the combined wisdom of expectation forecast from millions of these micro trades being done. And that is also working just fine right now. There's, buyers and sellers are still out there competing, and it's a highly competitive marketplace, Mark.
Let's now get to maybe what everybody's waiting to hear. And that is it different this time? And around that idea, what have markets done in the past to recover from other high levels of uncertainty?
Yeah, and that's actually the big one, because everybody's is looking and saying this is unprecedented. We've never seen anything of this nature. And I do have to tell you, folks, there's no reason to sugarcoat it. This is unprecedented. We have never seen anything like this. Even though this is different, it's probably more dangerous, whatever it is. But can we look back and draw some lessons from history, or should we ignore all that? And I think it's the same with the markets. This is a unique situation, but maybe we can find a few things that are the same and are common with previous situations that would help us maybe get a handle on this one. And obviously, even this is different. Like you look at the headlines, unprecedented, the world is different, it's never going to be the same, and we're in big trouble.
Great Depression. I think a Great Depression's coming.
Great Depressions, exactly. So you look at all of these, and the question is here, have we heard this before? Perhaps there are times when we had exactly the same headlines. And the one that is still on people's mind, relatively fresh, is 0809. The whole financial system is about to collapse. We can't have an economy with a financial system. The unemployment was high. We're doomed. How are we ever going to get out of this? Yeah. And sure enough, we did. But the ones that I want to refer to are ones that I wasn't around as a way to, assess them as a grown-up. So in my mind, maybe the way I thought about it, can I almost like build a time machine and have this time machine take me back to see how did investors feel at those moments. And the first stop on my time machine would be 1973.
Okay.
So in 1973, there were a few things that were huge. The first one was that up until 1973, there was a pledge by the U.S. government that if you bring us dollars, if you bring us $35, I think, you get an ounce of gold. So the money that we used was backed by gold. For every dollar, there had to be more gold. And that was called the gold standard, because everybody knew that the currency is backed by a precious metal. Well, in 1973, President Nixon said that the government would no longer pledge that. So what he did, think about this, in terms of financial terms, the whole time you think that the money that I have has value because there's gold waiting for me there. And all of a sudden you're being told, no, that money only has value because other people believe it has value. It's called fiat money. And there was a huge change. And then what you got was inflation. You had, wage controls and price controls. And, I think the cherry on top came in the fall. And in the fall, there was a crisis in the Middle East. And to show their displeasure with the way that the American policy towards the region was playing out, the Organization of Petroleum Exporting Countries, or OPEC as we know it, they decided that they will put an oil embargo. And all of a sudden, we ran into this oil crisis, meaning that we just didn't have enough oil. And back in those days, again, this is where I would take my time machine. I would take my time machine at 1973, and what I like to do is I like to be in a station wagon, sitting for hours with lines that were just tremendously long, sometimes in miles, waiting to gas up in my big gas guzzler, knowing that I probably have to gas up by the time I go home. I have to come back because it's empty again. But I'm sitting in that car for hours waiting to get gas, and I read headlines such as the world is different. Our whole economy depends on oil that's coming from countries that are not willing to give us to us anymore. We are doomed. How can we possibly go grocery shopping? How can we have an economy? We can't even transport food across the country without gas. And now we are doomed. On top of that, the money has no value because it's not backed by gold. And if I'm sitting in that car for hours reading these headlines, how panicked must these people have been? Our parents.
Yep.
I mean, it's crazy. I was a kid, so I don't remember these, but maybe we can ask our parents, how was it sitting in that line for hours just to gas up, to be told that we might not have gas, we might run out of gas by the time we get there. So that was really scary. And the world did change. So this is the first lesson. The world did change. And how did it change? We have become the largest oil producer in the world. And we went from these gas guzzlers to something that's a lot more fuel efficient. So we did change. So that's the first lesson. But the second place I'd like my time machine to take me is somewhere that's being used right now as a comparisons in the media. And that is a war. We're at war as a society. And we don't have a visible enemy. It's like a little thing called the coronavirus, but we are at war and we need to pull together and defeat the enemy. Well, the last big one was obviously World War II. And, I'll take my time machine to 1936. Olympics are in Berlin. Hitler's presiding, and you kind of know the way the world is going. And 1937 was a terrible year for the stock market. It dropped by roughly the same amount as the great financial crisis, by 35% lost, more than a third of the money lost in 1937. 38, there is a quick rebound. 39, the war starts, the market's down again. 1940, Germany invades Europe. You kind of see that it's becoming a global war, and the market's down again. 1941, the market's down again, and the U.S. enters the war in December. Now, I'll take my time machine into a little house, dimly lit somewhere in the country, with an old radio playing all these terrible news that were going on in the world, and I'm sitting there thinking, what about investing? What should I do?
Right.
4 out of the last 5 years, I've lost so much money in the market. There is no consumer economy. Cities are being destroyed, and you have millions of people dying. Friends are being sent on the front lines and dying. It had to be a horrific time to think about investing. And there's nothing good that you can see there. And yet, what's incredible that even though the market historically is about 9-10%, 42 to 45, the years of the war, the U.S. market did not return 9 to 10% per year. It actually returned over 20% per year during the darkest days of our parents' generation, which is stunning. And to me, you can look at it and say, well, war is good for business. I don't know that's what I would look at it. What I would look at is something that is similar to what we see today, which is the fact that in a capitalist society, when you live in a free markets world, these companies that we know and love, they seek opportunity. And in plain English, they will try to find a way to make money in whatever state of the world we're in. If they cannot sell cars, they'll make tanks. If they can't sell toys, they'll make bullets. And that's exactly what we see today. You see that distilleries are not making spirits, but they're making hand sanitizer. You see that Ford and GM, they're repurposing their assembly lines to make ventilators because that's what sells. So to me, the thing that's still here and it hasn't changed is the fact that is an entrepreneurial spirit And these companies will find a way. Whether the CEO works in the pajama from the bedroom, they'll find a way to get out of it. And ultimately, that hasn't changed. The free market, entrepreneurial, and the markets are resilient because these companies are resilient. And these companies are resilient because us as people are resilient. Mankind is resilient. And that's, I think, hasn't changed. So from my perspective, it is different, and there are some things that are the same, whether it's the fact that will be a change, which is not really clear what it will be today, and also the free markets will help guide the way out of this.
So, Paulo, can you show us some of the recovery data from previous markets when we had 20 or 30% declines?
Yes, absolutely, because that's really important, because you do want to see when you look at this, have we seen this before? And it turns out that just intuitively, the history of the market is a history of bull and bear markets. It's not always been that the market's gone up or the market's gone down, but see, there's a sequence, and there are times when the market goes up, then it goes down. And just observations, you look, the bull markets tend to run longer than the bear markets. We've been in the bull market for about 11 years. So it's not really unusual to see that hey, there's a pullback, there's a decline. So in that respect, it's not unusual. Just it's not without precedent. So it's not pleasant, but it's not without precedent. And it's to be expected. There's just nothing really crazy about the market pulling back, even by 20%, as we've seen now. Now, the question for investors is, as we have this 20% drop, what do we expect going forward? What is the data telling us about, not just right now, but what's ahead? And when you look at that, fast forward now, what you see is that look, the historical market's been about 9-10% per year. But what you see is that whenever you have a 20% decline in the market and you run the analysis, what happened subsequent to that? So when you look at the following year, on average, what do you see the market doing? On average, after a 20% decline, does the market continue to go down, or does it go back up? So when you analyze the data, what you see that on average, a year after the market dropped by 20%, it goes up by 14% per year. And that is above the historical average. So in a sense, what you see is that we see the drop, but in the subsequent year, on average, it goes up rather than keep going down. And that is sustained over the 3 and the 5 year periods. And that's, again, it's really good news for investors. So if you grow at this rate, you probably are looking over 5 years at about a 70% gain from where the market dropped. So it is something that we looked at, and again, it's not pleasant, but at least the data historically shows there is a sequence. And after you see the 20% drop, you don't necessarily see that on average there's more pain, but rather there's a gain that's above the historical average.
Paulo, maybe just leave that up a second. I have a question that came in, but one question that came up relative, I think, to this slide is past catastrophes have nothing to do with today's catastrophe. And I'll give you a shot at it first, and then if need be, I can pitch in my own version of it.
Well, why don't we start with your version, because I love to hear it, because you've been doing this for so long. So go ahead.
So we're actually right in the process this morning of taking an old video we did from 2012 about the idea of, this time it's different. John Templeton was famous for saying that the 4 most dangerous words for investors are "this time is different." So what makes each time relatively similar is the fact that we can reprice the investments to the catastrophe. So it's a given that things are different. Come on. I mean, every day we have a different set of circumstances, as Apollo mentioned in the beginning. But what levels this out, and actually what makes capitalism work, is we get to reset a price so that from that price, the buyer and the holder of the investment is positioned to get a risk-appropriate return. Now that's over a risk-appropriate holding period. So many of our investors are well aware, if you're holding a 100% equity portfolio, we tell you your average holding period you should be thinking of is 15 years, not 1 or 2 or 3 years or 5 years, like you see in this chart. And so the key thing to remember is what is constant throughout all kinds of changing market conditions is the ability of a buyer and a seller, a willing buyer and a seller, to reprice that event so that the investors set up for a positive expected return. Now, the word expected refers to this bell curve of outcomes. So we're not telling you you're going to get 9.6% like you see in this chart. What we're telling you is there's a range of returns, and unfortunately, nobody knows where your return, your realized return, will be in that distribution. How's that, Paul?
That's fantastic. I mean, it's very well said, and I particularly liked what you said is like look at your return, because I do want to take one step further on that line. When we're talking about your returns, there are a few things that are absolutely crucial. What you experience in your own portfolios, it is likely to be different than what you see on the news. When you see the market dropping and say, oh, I'm losing my shirt, wait, time out. You need to figure out exactly what is in your portfolio, because on one hand, you do have not only stocks, but you could have some bonds. So right. In that respect, there is a difference. But more so, even within stocks, the way that you can consider allocating today as a modern investor is not looking only at the US. And in fact, if you redraw a world map, not based on landmass, but the value of all companies that you can buy and sell around the world, what you see is that the US, with these 3,000 companies, amounts to about 54%, a little over half of the value of all companies around the world. Yes, we do have Ford and GM, but there's also a BMW and a Toyota. And around the world, there are 9,000 plus other companies, which could be part of your portfolio in this globally diversified approach. And when you buy all of these, there's another element that the results that you get in your own portfolio might not be exactly, even if you have 100% stocks, exactly like what's on the news, particularly since Dow Jones is only like 30 out of 3,000. So It's really important to pay attention to that. And one more thing, I do hear a lot lately that people are concerned that international and emerging markets might not be as well equipped to get out of this mess as the U.S. And they're wondering, as an investor, should we put more money in the U.S.? And it was interesting because I looked just this morning, just out of curiosity, to see what's going on. And maybe before I talked about this morning, 2 weeks ago, that was the last time I had a chance to read The Economist, which is a phenomenal publication. And in that article 2 weeks ago, it pointed out that the worst performing stock market at the beginning of the year was China. As we kind of we kind of expect they're going to the quarantine and the economic slowdown. Yep. And what the article pointed out that as of 2 weeks ago, China had become the best performing stock market in the world. And in fact, their version of the NASDAQ apparently was in positive territory. That's so interesting. And what I did this morning, I looked to see, well, is that still the case that China is the best performing stock market in the world? And it's not. It's not. It's now the second best stock market in the world, with the best one being this beautiful country of Norway. Or no, I'm sorry, Denmark. Denmark being the best performing country in the world. So Denmark is number one, China is number two. And I'll tell you what was shocking to me is that the US is not in top 10. When you look at the top 10 performing stock markets around the world, the US is not in the top 10. So I do think there's value in having not just US company, but really going around the world. And if you do this, and maybe I'll kind of try to circle back to actually have a point to this. If you look at these three periods, 1973, I'm going to put the 2000 dot-com crash because it was so painful time for investors, and then the 2008. And you kind of say, well, if you had invested in the S&P 500, which is the way people might look on the news and say, this is what my experience is. Well, how many years in the red would you have been in the S&P? And it turns out that in 1973, it would have been 3 years in the red, with the worst being in 1974 with about a 26% drop. During the tech crunch and the tech bust, it would have taken 6 years underwater. You would have been above water at the seventh year mark. And there was a negative 22% in '02 as being the worst. And after the financial crisis, 4 years in the red, you're back in black after the fifth year, and it was a negative 37%. And that's what people might say, I don't want this to happen to me. But the way that you are investing money, the S&P 500 is part of it, but you also have a global allocation. In other words, one piece of it is the S&P, but you have more than that. So instead of US only, it's global. And for most people, it might also be balanced. So it's a global balance between stocks and bonds. And as I said, everybody's mix is different. But if you look, the most generic one out there is 60% in stocks and 40% in bonds. How would that experience have been different if you had a global balance 60-40? And this book that we have, the Matrix book, does have that answer. So when you look at 1973, this global balance 60-40, instead of 3 years in the red, you would have been in the red only 2 years with about a negative 11% downturn. So not negative 26, but negative 11. During the tech crunch, instead of 6 years, you would have been in the water only 1 year with the negative about 4%. And then after the great financial crisis is 2 years with a negative 24%. So the two things that is important for your clients to hear is that number one is the experience that you get is going to be different. And sometimes if you're in a global balanced portfolio, it is possible that these very negative returns are not exactly what you see in your own. So you might see different results, and if you have bonds, are likely to cushion some of the downturn. But the other big one, which is, as I looked at this, the longest a 60-40 balanced portfolio, globally balanced 60-40 portfolio would have been underwater, it's 2 years. By the third year, you're back in black. In other words, it doesn't take years and years and decades to recover. If you have this global balance, there's a good chance that you would come out of that mess a lot quicker than simply being in the U.S. stock market.
Very good. Let's see. I have a question about market timing. Do you mind if I put a chart up on the screen?
Not at all, please.
Okay. So can you all see this? The problem with market timing, missing the best days?
Yes.
See that okay?
Yes.
So the question that was just submitted, it says, I've heard if you had missed just one day in the market on the last rebound, it could have changed everything. Can you speak to that? And so I want to use this. This is one of the reasons that market timing is so difficult is I think on average, it's about 3 to 4 days per year that comprise the entire return for that year. But look at this table for a moment. If you went back 20 years and you looked at the S&P 500 over that 5,035 trading days, the annualized return in this specific period was 6% a year, so that a value of $10,000 grew to $32,000. But if you just take out the 5 days with the highest return over 5,000 days, it turns out that your return drops down to 3.87%.
Wow.
And that means you've lost 48% of the gain on your investment over that particular period of time. And by the time you get to missing those 40 days, you actually end up with a negative return. That's 40 days out of 5,000. And so this is why market timing is probably the least likely to be a successful investment strategy. And it's why everybody should really avoid it.
Oh, I think that's you hit it. I mean, you have to be there for the market. And, Mark, you probably, your clients have been with you for a long time, so they probably heard this. I'm talking to some other folks who are more recent to this approach, and then to them, it is scary, and they feel like, maybe I should sit this one out. Maybe it is a good idea to cash out. And you've given some phenomenal reasons why you want to stay. The perspectives that I learned over time talking to other folks and from my own experience is that, if you do feel that urge that I need to get out of the market, you have to consider that you also need to make an equally important decision at exactly the same time. When do I get back in? And I don't know anybody who can consistently tell you when to get in out. If you think that Dow at 21, 22, whatever it is these days is too high, what's the right number? Is it 19, 20? What if it never gets there? And I have to tell you that the people who are telling me, I'm going to sit this one out, when things calm down, the smoke clears, I'll come back in the market. Well, I have some news. By the time the smoke clears and things kind of return to normal, it is very likely that the market would have gone up by then. And that's what happened in 2009. It was the worst year of the economic recession. And yet in 2009, the market went up 26%. And if you're sitting there saying, I'm going till the smoke clears, well, you missed it. And what it could have been a temporary paper loss has now become a permanent loss. And the other thing that I've learned from my own way is that, when you sell and you think I eliminate the stress of investing, that's not true. You're just replacing the stress of being in the market with the stress of being out of the market.
Exactly.
I used to kind of say that after I sold, I slept like a baby. I would wake up every 2 or 3 hours and cry. But the reality is that what happens is that you have stress. Imagine people sold and they saw the 20% increase in 3 days. Can you imagine the stress they must have been under, saying, "Oh gosh, I missed this, and why didn't I just stay in?" So don't think that the stress, that the emotional side is addressed if you sell. You're just replacing one stress with another.
Yes. Another quick question. One of our clients asked, in a typical DFA portfolio of investments, how can I tell what the ingredients are in each fund, each individual fund, as to its global versus U.S. companies?
But the way that we do it is we have funds that have very clear mandates. And every single day, if we have a fund that is the mandate is for the U.S., that's the only thing that it holds. So their algorithms and their basically screens every day. And obviously the portfolio managers can see, is that a U.S. stock or not a U.S. stock. So we're very, very precise. And so we have typically U.S. funds. Then we have what's called International Developed Fund, which is sort of the light blue here. And these are designated countries that belong to what we call international developed. And there's a third category that's emerging markets. So the way we do it is that nothing at Dimensional is purely algorithmic, that the computers take over and do things. Not at all. Think of it as flying a plane. You do have a computer to help you, but you also have a pilot in the cockpit. So there's always a pilot in the cockpit to look to make sure that these portfolios are doing exactly what they're supposed to do. And that is done on a daily basis.
Right. Okay. Questions keep coming in. What happens after a 35% drop? I think we showed him at 30. So first of all, we don't have a lot of those. I actually looked at the data set that generated that table that or those charts. I've looked at the table of data, and right. I think we only had 6 or 7 30% drops. But the answer, let me just take a first shot at this, and you can take your own shot after me. The answer is the same. The market is setting a fair price all the time. To me, this is one of the most difficult concepts for all of you, everybody listening, to get into your heads, is that the market is arriving at a fair price. If you don't think that's an important concept, I just want to remind you that Eugene Fama, the guy who sits on the investment committee and designs most of the indexes at Dimensional, earned a Nobel Prize in 2013 for this very idea that market prices include all available information. Yep. And as Apollo said at the beginning, that includes the forecasts of these buyers and sellers. And Louis Bachier in 1900 wrote in his famous paper called The Theory of Speculation, at this very same moment, the buyer thinks it's going up and the seller thinks it's going down. And through this sort of invisible hand of negotiation of buyers and sellers all over the world, 10 million of them, we reach a fair price. And from the fair price, the buyer and the holder is positioned to get a fair return, but they have to accept the uncertainty of future return. And I have to say, you know, I've been doing this 21 years. We just passed 21 years. And it took me a long time to understand that myself. Maybe after saying it 2,000 times, I think this is my 10,000th time, it really started to sink in my brain. But I guess I would challenge all of you out there listening to come up with a reason that all that information would not be in the price.
Right.
I like to remind investors when they read me yesterday's news, is it rendered useless because the new price already includes it? And the answer to that question is yes. Right. Maybe you can expand on that. I mean, this is the essence of dimensional fund advisors. One of David Booth, their most famous quote, for me anyway, is it's all about the price. Investing has always been about the price. And yet we get so many questions talking about the news. Well, the news is already in the price. You can now forget about the news.
Right. And I would say that when you look at investing today, the news that you mentioned and what goes in the price, it's not the headlines that are making people trade. The level of information that investors have about an individual company and the sophistication in terms of what they apply to make these expectations about profits going up or down goes well beyond the headline news. I remember reading about this company that was created to basically provide information to investors, and what they do is they launched an army of mini satellites into space, and they snap pictures of Walmart parking lots to figure out if there are more cars or fewer cars to kind of make a determination of what the sales might be. They have detectives snapping pictures of people's carts to find the value. That's the level of information that market participants have. Market participants don't listen to the news like, let's go buy and sell some stuff. That's not how it works. They have a level of data and sophistication that is beyond any one individual. They're not paying attention to news. By the time they heard the news, it's likely they knew that 20 minutes in advance, because that's what it takes to get information. It costs money, but it benefits you, and they get it before any of us do, legally speaking. I mean, sophisticated professional investors. But there are two questions that maybe if I can quickly touch. One is kind of looking and saying, why are we using data back to 28 when really it's been the asset class investing that's more recent? What has happened in the academia and the professional world is that over time, there has been a huge effort to recreate and look back at the data of history. And there is a particular university, University of Chicago, who has something called the Center of Research in Securities Prices. And what they've done is they've reconstructed some of the data going back to 1928. So it's still very useful to go back in time. And the other question that was there that I thought it was interesting, and it comes up quite often, what about the government and the stimulus? What will that do? And I'm not sure that's a question of interest to you, but I did see it there that I was reading. And anyway, but I want to pass it on to you.
Yeah,
well, I think that what's interesting, because I've looked at this and from an economics perspective, what I find interesting is that when the government spends money, and then there is this big bill that came out, it typically is considered to be a stimulus. And the stimulus, the main idea of a stimulus is by spending money, you are stimulating demand, because you give money to some people in the pocket and they go spend some money, and that is the stimulation of demand. Well, it turns out that this is not really a stimulus, because right now, not only that the demand is not the problem, the demand, you can give me as much money as I want. I'm still locked up in the house. I'm not going anywhere. And on top of that, supply is a problem because you don't have people working in factories. So this is not necessarily a stimulus that is looking to either boost production, because you cannot boost production. People are not at work. And it's not a demand problem because people can't spend. This is more of a liquidity play, that the government is realizing that there is a liquidity crunch right now, and it needs to be addressed. And it's almost like, rather than saying who's unemployed and who's not unemployed, let's take the hose and give everybody money, because that is better than the alternative. So again, I mean, to me, it's in my personal opinion, it is a way that they've learned from the 0809, when one of the things that he saw is that number one, it took them too long to do something. Number two, they were a little shy and they underestimated the problem. So now looking at the data and the evidence from those days, they're kind of saying, well, let's not do that. Let's be a lot quicker, which they have been, and let's actually not underestimate the problem. And maybe, if anything, if it's overreaction, so be it.
Yeah. One more question just came in. Before we go to more questions, I kind of want to wrap up our outline, and maybe one of the more important issues here, and that is, given all of these things we talked about, what should investors do now?
Yeah. So I think that that's the big question. I mean, all this has been about the past, but if you go forward, what do you do? And I think these are the two fundamental choices that you have. These are the two strategies. One is to decide to sell, wait on the sidelines. And I do believe that that strategy is actually creating more uncertainty, more risk, more pain. And I'm not an advocate of that. What I think people should do right now is, the very first thing is go back, talk to the advisor, review the allocation in your portfolio, make sure that's consistent with your risk capacity. And I know you guys at IFAs have really robust risk capacity surveys, and make sure that the allocation, that the risk capacity that he filled out was accurate, because there's different thing looking and saying theoretically the market can drop, but when it actually happens,
it feels different than you thought it did.
Yeah, like Mike Tyson. Yeah. Mike Tyson has said everybody has a plan until you get punched in the face. So it's kind of like that. So, but I think that what investors should do right now is go back, look at the plan that they established with the advisor, and I think that going back to the plan and looking again is the first thing that you should do. The second thing that advisors should do, and the clients, is basically look at this, and based on a predetermined system that was put in place before this happened. So you want to take away the emotion. You look at that balance between stocks and bonds. And if the stocks have dropped, maybe a little bit counterintuitively, but what you want to do is you want to trim some of the bonds, take some money and replenish the stocks. In other words, even if the stocks are falling, that's might be a good time to buy. Don't treat stock drops with panic, but rather as an opportunity. And then when you do this process called rebalancing that gets everything back in balance, the benefit of that is that when the market rebounds, you're not too light on stocks. You're not underweighted in stock, and that will bring you back in line. So rebalancing is the one action that I say might make sense for some people. It has to be done carefully. The advisor has to examine each circumstance. And the other thing they can do, the third thing that he can do, review allocation, rebalance. And the third one is if it makes sense, it not always makes sense, but if it makes sense, see some of the holdings that have dropped in value and see if it makes sense to maybe sell and find something similar that he can invest with. But by selling, even though it's painful to sell at a loss, that becomes a deduction for taxes. Because when you have gains in the future, you can take this loss and offset the future gains. And that is called tax loss harvesting. For some people, it might make sense. For others, it might not make sense, depending on your own situations. But that's an activity, that's an action that I think investors can at least explore with their advisor at this moment in time.
So now, Paul, I can see why you were a professor.
Because I don't have any hair?
Well,
I'm just kidding.
No, because you're doing such a great job.
Because I have a crystal ball. That's what I have. You should ask me.
Go. Yeah, tell me the future, please. Tell me the future.
Let me rub it a bit.
Let's see. So I had another client here. So one of the questions that came in: how many clients at IFA have actually sold and gone to cash? And so I can tell you we're pretty happy with this. Out of 2,000, 475 clients, something like that. Let's call it 2,500 clients. The last count I had was we had 31 of those clients go to cash in their portfolio. And in just about every one of those cases, we've worked hard to try to get the client to understand how markets work, how we have fair prices all the time. And And so we're not pleased to see anyone sell out of their portfolio, because I think the hardest part for us, that meant they didn't really understand our education and our 12-step recovery program for active investors, step 4 in particular about market timing. But I also understand that some people have these emotions, and we have to accept this, that you're in pain. But as Apollo said, now you have this new pain of, when do I get back in?
Yeah.
And it's often said that you need to get lucky twice to do better than the buy and hold investment. And I can assure you, we have an internal study that you've probably all seen in my previous video about epidemics and stock market returns, that when clients didn't follow our advice and they tried to scoot around this market by going to cash or moving around their portfolio too much, they only ended up capturing about 78% of the return they would have earned had they more perfectly followed our advice, including rebalancing, which means selling the investments that have done well so far and buying more of those investments that haven't done so well, so that you get back to your proper balance that matches your target allocation that we determined was appropriate for you, given your answers in the risk capacity survey. What I like to call risk maintenance, keeping your portfolio in balance. Now, some clients think this is an opportunity for them to take advantage, of a certain upturn in the market. I don't accept that. We don't know when these markets are going to upturn. And in fact, it was 18 months in 2008 and 2009. And I know a lot of clients rebalanced after, the first 20%, thinking now is the time. It's a bear market and we're going to get this thing, back, real quick. Well, that wasn't the case. I think in a full equity portfolio, we were down 62% from day to day. And so do not think that you're a market timer and rebalancing is going to position you to necessarily do better. All we're trying to do is maintain the risk exposure that we have concluded is appropriate for you throughout different market conditions. And we don't want to overdo that. We don't want to do it daily. It creates lots of trading costs and all kinds of issues. And we can't really trade that often. It would be enormous amounts of trades with all these positions. So so that's kind of my addition to what you were talking about.
That's great. That's great.
So let's see. I don't know if we have any questions, but listen, Apollo needs to go. And I just want to thank him so much for sharing his wealth of knowledge and experience in talking to end clients like you. And also, I've told this to some of the other people at Dimensional. I don't think that they can really appreciate how many lives and how much financial security they impact of investors throughout this world. They're all over the world, advisors all over the world using their excellent product. And I know some people think I'm a salesman for Dimensional and that I'm getting some commission. In fact, that was one of the questions. What's our relationship? Listen, our only relationship is I'm an independent registered investment advisor who's the fiduciary for the client. And we have to do what's in your best interest. And it's when we study mutual fund companies all over the world and we look at all of the options that we see for investors, we don't see anything better than these passively managed investment funds designed around academic research, backed up by Nobel Prizes all over the place. What do they call it? Killer's Row there, Apollo? How many different Nobel Prize winners have contributed? 4 or 5?
4 or 5, yes.
4 or 5 to the dimensional strategy. And, I challenge any of you out there to show me some firms that you think do a better job at this. In fact, I often throw out Fama's resume when you think you have a better investor. Somebody threw out the question about, what about the Big Short, Michael Burry, and maybe we should be paying attention to him. Give me a break. Take a look at Fama's resume by going to our website and typing in Fama one of a kind, and I'll put Fama's resume in financial economics. That's the area of investing, or the area of economics dealing with stock markets. I'll put his resume against anybody, right?
And by the way, I think you're much better at selling dimensional than I am. So thank you. And what's interesting is that I've known Mark for 15 years, and in 15 years, our two firms have not exchanged a penny financially. Like, we've never paid IFA a dime for using the funds. They do it because of what he said. They think they're fitting the best for your clients, and we appreciate that. But it's not because we pay. He's not allowed to, I think, legally, to take any incentives from any financial products.
So anyway, thank you so much, Apollo. We really appreciate your guidance and education today. And now that we're all stuck at home, maybe we can do this another day.
Anytime, I'd be more than happy. I really enjoy working with you, Mark. So it's been a pleasure.
Likewise.